Today, we're exploring an important moment in economic history that changed how the U.S. dollar functions. In 1971, President Richard Nixon announced a change to U.S. monetary policy. This decision affected how currency operates in America and globally. If you're interested in learning about economics and monetary history, make sure to subscribe for more educational content. Let's dive into what happened and why it matters. On August 15, 1971, President Nixon announced that the United States would suspend the convertibility of dollars to gold. This was called the Nixon Shock. Before this change, the U.S. dollar operated under the Bretton Woods system established in 1944. Under that system, the dollar was convertible to gold at $35 per ounce. Foreign governments could exchange their dollar reserves for physical gold. By 1971, economic conditions had changed significantly. U.S. gold reserves were declining as foreign nations requested conversions. The government faced a choice between maintaining the gold standard or changing the system entirely. Nixon chose to suspend gold convertibility. This shifted the dollar from a commodity-backed currency to what economists call fiat currency. That means money that derives its value from government regulation rather than physical backing. After 1971, U.S. policymakers worked to maintain international demand for dollars through other means. In the mid-1970s, agreements were reached with major oil-producing nations to price oil in U.S. dollars. This became known as the petrodollar system. Because oil is traded globally and every country needs energy, this created sustained international demand for U.S. currency. Countries needed dollar reserves to purchase energy resources on the global market. This system has been a significant factor in maintaining the dollar's role as the world's primary reserve currency for the past 5 decades. Today, the Federal Reserve manages the money supply through several different approaches. One method is called open market operations. This is where the Fed buys and sells government securities to influence the amount of money flowing through the banking system. Another tool is quantitative easing. During economic crises, the Fed can expand its balance sheet by purchasing assets, which increases liquidity in financial markets. The Fed also sets target interest rates that influence borrowing costs throughout the economy. When rates are lower, borrowing becomes cheaper. When rates are higher, borrowing becomes more expensive. These tools allow central banks to respond to economic conditions with more flexibility than commodity-backed systems allowed in the past. One effect of fiat currency systems is that purchasing power changes over time. Since 1971, the dollar's purchasing power has decreased substantially. According to Bureau of Labor Statistics data, what cost $1 in 1971 costs approximately $7.70 today. This is measured through something called the Consumer Price Index, which tracks the average change in prices over time for goods and services that people buy. Inflation occurs when the money supply grows faster than the production of goods and services in the economy. Central banks aim to manage inflation through the monetary policy tools we just discussed. Fiat currency systems allow governments to maintain higher debt levels than commodity-backed systems typically could support. The U.S. national debt is currently over $36 trillion. Just the annual interest payments on this debt approach $1 trillion per year. Economists continue to debate the sustainability of various debt levels and what constitutes responsible fiscal policy in a fiat currency system. Now let's look at how this system is continuing to evolve in the modern era and what new developments are emerging. The international monetary system continues to evolve in interesting ways. In recent years, some countries have begun diversifying their reserve holdings away from being purely dollar-focused. China, Russia, and other nations have reduced their percentage of dollar-denominated reserves. Here's a striking statistic. The share of global reserves held in U.S. dollars has declined from 73% in 2001 to approximately 58% in 2024, according to International Monetary Fund data. Additionally, some oil-producing nations now accept multiple currencies for energy transactions, not just U.S. dollars. This represents a shift from the petrodollar system that was established in the 1970s. These represent gradual but significant shifts in the international monetary system. Central banks worldwide are researching digital currencies, commonly known as CBDCs, A CBDC is a digital form of central bank money. It's different from cryptocurrencies like Bitcoin. Instead of being decentralized, it would be issued and regulated directly by the central bank. China has already launched a digital yuan pilot program with over 260 million users participating in the trial. In the United States, the Federal Reserve published a discussion paper titled Money and Payments: The U.S. Dollar in the Age of Digital Transformation. This paper explores potential approaches to a digital dollar. CBDCs offer several technical capabilities that traditional currency doesn't provide. They enable real-time payment settlement across borders. They could enhance how monetary policy gets transmitted through the economy. They might improve financial inclusion for underbanked populations. And they could reduce transaction costs compared to traditional payment systems. Policymakers are studying both the potential benefits and the concerns regarding privacy, cybersecurity, and broader economic impacts. Let me share some key statistics that illustrate how modern monetary policy has evolved. The Federal Reserve's balance sheet grew from $870 billion in 2007 to over $9 trillion in 2022. That's more than a tenfold increase. M2 money supply, which measures the total amount of money circulating in the economy, increased 40% between 2020 and 2022 alone. Meanwhile, median wages adjusted for inflation have grown just 0.3% annually since 1971, while productivity has increased 77% over the same period. These data points show the relationship between monetary expansion and economic outcomes across different sectors of society. Throughout history, different monetary systems have existed and evolved. Commodity-backed currencies like the gold standard provided price stability but limited policy flexibility. Governments couldn't easily respond to economic crises because they were constrained by gold reserves. Fiat currencies provide greater policy flexibility but require careful management to maintain value over time. Without commodity backing, trust in institutions becomes more important. Economic historians note that currency systems evolve based on technological advances, political factors, and changing economic conditions. What works in one era may not work in another. The monetary system we use today is quite different from what existed 50 years ago. The derivatives market now exceeds $600 trillion, roughly 10 times the size of global GDP. The financial system is more interconnected and complex than ever before. As the petrodollar system continues to evolve and digital currencies emerge, we may be witnessing another significant shift in how money functions globally. Understanding monetary policy helps us make informed financial decisions and understand the economic forces shaping our lives. The 1971 shift from gold-backed to fiat currency represented a fundamental change in how the U.S. dollar functions. That decision created the monetary framework we still operate within today. The system continues evolving with developments like declining petrodollar dominance and emerging digital currencies. These changes will likely shape the economic landscape for decades to come. For more educational content about economics and finance, please subscribe to this channel. Thanks for watching this overview of monetary policy history.